Man, it's your boy Crypto Blood. Welcome to another episode of My 2 Cents, where we cover the latest news, finance, cars, tech, pop culture, all that good stuff. All non-crypto related info, basically. My song pick for today, Sada Baby featuring Draco. Some Detroit rappers, hot out here. Blocks Party. I love this joint right here. I'm rocking this out for today. What's good, people? Hope you guys are doing well today. We're gonna be talking about something. This headline caught my attention. I almost did the Scooby-Doo Shreggy. I couldn't believe I saw this headline. This is out of ZeroHedge. And before we get started, I thought about it. I'm like, I used to really read ZeroHedge faithfully all day, every day. I don't know about you guys, but ZeroHedge has some of the worst ads. They just bombard you with ads. It just basically shuts down your computer if you don't have ad blockers on there. But God, I think that's really why. You guys let me know, do you guys still read ZeroHedge? Maybe I should put it in like an RSS feed so I can read just the text, but I don't go on ZeroHedge that much, and I think it's because of the ads, to be honest with you. I really think it's not the content. I think it's just too many ads for me to deal with. But anyway, we're going to try to get through it today. This is out of ZeroHedge, and look at this headline, people. Retail investors can now sell credit default swaps using an ETF. Absolutely crazy. So when I saw this, I had to cover this, guys. So we're going to take a look at this really quickly. For those that may not know what a credit default swap is, it's almost like a side bet on a particular asset. It's a derivative. So you've got two parties, and one is promising to pay the other if that asset or company, bond, whatever the actual underlying instrument is, if that instrument defaults. I really don't know how to take this, to be honest with you, because I look at this suspiciously, because why would they offer retailers the ability to profit off of the collapse? It's usually the good old boys that can do that with their sophisticated instruments and derivatives and all that stuff. So I haven't read the article. I don't even know if it's offered here in the States. I would assume this is not a US based or available product, but we'll look at that. But I don't know, man. What does that tell you guys? You think they would actually allow us to profit from defaults? So the article starts off talking about ETFs, and it says, having revolutionized investing for both ordinary retailers and institutions and increasingly crowding out traditional asset managers, ETFs have set their sights on yet another market to disrupt and dominate: the $1 trillion market in credit derivatives. 10 years after the financial crisis, a London-based provider of passive products is testing whether the trading strategy of selling default protection has appeal beyond a rare group of institutional debt investors, according to Bloomberg. The UK-based company listed an exchange-traded fund on September 7th that tracks a gauge of credit default swaps on European corporate bonds, joining only a handful of ETFs that offer similar exposure. I didn't even know about this one. I didn't know that there were other ones either. But anyway, it says here that Tabula is charging a 0.5% fee for holding these ETF products, allowing ordinary investors to join sophisticated hedge funds while bypassing the need for a burdensome ISDA agreement. The Tabula European Performance Credit UCITS ETF, boy that's long, works very much how a regular CDS does. It provides a long position in the region's credit markets by selling protection against default on a group of investment grade and high yield companies. The fund earns a coupon with this strategy, though in the event of a default or other credit event, it would be forced to pay out, causing losses. The prospect of bringing speculative credit trading to more mainstream investors, even the mom and pop crowd, would displease Pope Francis, who rebuked the market in May as a ticking time bomb. Yeah, I remember he actually said that this is going to crack you guys up. Pope Francis said that ETFs are unethical, I believe he said. I can't believe, we're not going to get on religion here, but man, who is he to talk about what's unethical? God, that's crazy. When I saw that, I was cracking up, man. Sarcastic religious commentary aside, the fact that banks are opening up CDS to retail means that there is increasingly little institutional interest to sell CDS, i.e. buy bonds. And as a result, the market must be opened to retail investors, who have been eagerly devouring the stocks that institutional investors have been selling to them in ever larger amounts in the recent years. So this is what I kind of was talking about. Like, we're the last ones to benefit from something. So to see them opening this up, to me, tells me they're passing the hot potato to us so that we, in some form or fashion, will crash and burn with this stuff. You guys got to let me know what your thoughts are on it. The article goes on to kind of pose the question, why wouldn't an individual just simply go buy a normal ETF that tracks cash bonds? It says here, what is the spin to get mom and pop investors hooked on doing what AIG infamously did a decade ago with devastating results? In other words, why invest in an index of swaps rather than buy a plain vanilla ETF tracking cash bonds? Simple. The former strips out interest rate risk from the question, according to the release from Tabula. They said specialist credit managers can isolate and manage credit risk using credit default swap indices. This is a liquid and efficient market, but it isn't accessible to all asset managers. On the other hand, it was not immediately clear why retail investors would be concerned about isolating credit risk, and furthermore, why they would then turn around and buy an index of swaps, which dilutes the impact of the single name focus. The article goes on to say, until recently, aside from a handful of passive products, the only way to gain exposure to CDS indexes was via derivatives and structured notes, instruments which allow investors to take short positions as well. It is unclear if the plan will work. While a handful of X-trackers, ETFs that track indexes of European CDSs, have managed to gather hundreds of millions in euros in assets, others have been less successful. In the US, ProShares closed one of their pairs of long-short products tied to North American CDS indexes, while the remaining fund, the ProShares CDX Short North American High Yield Credit ETF, holds less than $5 million in assets. So I guess I'm just late. I didn't know that there were a couple of ETFs out here that covered these CDS spreads. I was unaware. I did not know this. That's probably because I'm so entrenched in the crypto world. When I saw this, I was just shocked. But I guess it's been around for a while. Have you guys heard of this? These ETFs? Of course, I know CDSs and CDOs, but I have never heard of a CDS ETF. It's not surprising that retail investors aren't using these in the US, because most of them don't even know how to use them. Anyone sophisticated enough would probably be buying through their investment bank account, like a Goldman Sachs or something like that. So I don't know, you guys let me know what you think about this. It's getting ugly over there in Europe, and I think it's going to definitely have an impact on the stock markets around the world. Of course, probably the US being the last to really feel the impact. But yeah, you guys let me know your thoughts on this ETF that is tracking CDSs, man. This is amazing. Just more and more derivatives piling on top of each other. It's gotta end ugly. It's gotta end ugly, I'm telling you. It's your boy Crypto Blood. That's my 2 cents for today. And I will check you guys out later. Holla!